Today, I'll be breaking down Apple's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Apple's revenue has experienced moderate growth over the past decade. In fiscal year 2014, it stood at $182.8 billion and grew to $383.3 billion by fiscal year 2023. Over the trailing 12 months, revenue slightly decreased to $381.6 billion. This reflects a 5-year compound annual growth rate of 7.5% and a 10-year of 7.6%. Despite a slight recent dip, Apple has more than doubled its revenue over the past decade, which is impressive for a company of its size. When it turns to net income growth, Apple maintained an impressive 9.8% annual growth rate, resulting in a total increase of 154.1%. Earnings per share has also seen significant growth, from $1.61 in 2014 to $6.43 over the last 12 months. This 10-year average growth of 14.9% outpaces net income growth due to Apple's aggressive share repurchase program. With fewer shares outstanding, the earnings per share grow faster. Concluding this initial dimension, free cash flows had a total growth of 91.9%, averaging 6.7% per year. Apple's growth drivers over the past decade include innovation in products and services, expansion of the services segment, transition to in-house silicon, robust marketing and brand loyalty, global expansion and market penetration, and focus on ecosystem integration. Now, let's shift gears to profitability dimension. Apple's gross margin improved from 38.6% in 2014 to 45.6% over the last 12 months, a great improvement to have. On the other hand, Apple's free cash flow margin has remained relatively stable within the 20% to 25% range over the past decade. Lastly, the return on invested capital climbed from 31.7% in 2014 to 52.6%. This exceptional performance earns a rating of 5. Key profitability drivers for Apple include its premium pricing strategy, which allows the company to charge higher prices due to strong brand loyalty and perceived product quality. Economies of scale enable Apple to reduce per-unit costs by spreading fixed costs over a large volume of sales. The development of in-house silicon and vertical integration ensures tighter control over performance and efficiency, reducing reliance on external suppliers. The high-margin services segment, including Apple Music, Apple TV+, and the App Store, provides a steady stream of recurring revenue with minimal production costs. Operational efficiency and sophisticated supply chain management minimize waste and reduce costs, contributing to higher margins. Lastly, a diverse product mix and profitable accessories like AirPods and Apple Watch complement the core product lines, further boosting overall profitability. Moving on to the solvency dimension. Apple's debt-to-equity ratio increased from 0.32 in 2014 to 1.79 in 2023, but decreased to 1.41 over the last 12 months, reflecting a more balanced and healthy leverage level for the company. Comparing Apple's cash position of $67.2 billion with its total debt of $112.7 billion, the company holds a net debt position of $45.5 billion. Despite this net debt, Apple's net debt to EBITDA ratio over the last 12 months stands at a very secure 0.29. Over the past 5 years, Apple has maintained an average net debt to EBITDA ratio of 0.35, and over the past 10 years, this average has been 0.37. This demonstrates Apple's effective management of its debt relative to its earnings, ensuring strong financial stability. Lastly, the debt-to-free cash flow ratio is 1.15, indicating it can pay off its debt with just over a year's worth of free cash flows. Now the important fourth dimension, valuation. Until now, we've seen that Apple is an outstanding business. But what about its valuation? Apple's EV-to-sales ratio has increased significantly over the past decade. Starting from 3.75x in 2014, it climbed to 8.66x today. This means that Apple has never been so expensive relative to its sales. Similarly, price-to-free cash flow ratio rose from 14x in 2014 to 36x today. Finally, price-to-earnings ratio also increased from 17x in 2014 to 32.5x. These high valuation multiples reflect the market's excitement about the recent announcement of Apple Intelligence. During the WWDC 2024 held on June 10, Apple introduced Apple Intelligence, and new AI system integrated into iOS 18, iPad OS 18, and macOS Sequoia. This system, powered by a combination of Apple's technology and OpenAI's ChatGPT, aims to enhance user experience through advanced AI capabilities. We'll have a deeper look at Apple's valuation in the DCF Valuation next, so stick around. And while you're here, make sure to hit the like button and subscribe to the channel so you don't miss any future videos. Now, the fifth and last dimension is the shareholders' return. Apple's dividends have grown from 45 cents per share in 2014 to 96 cents today. This represents a 10-year average growth of 7.9%. Due to Apple's stock price appreciation, the dividend yield decreased from 1.6% in 2014 to 0.4%. The key metric of shares outstanding indicates that Apple has actively engaged in share buybacks over this 10-year period, leading to a remarkable decrease of 36.2% in the number of outstanding shares. I'll repeat, over the last decade, Apple bought back more than one-third of its outstanding shares. This is insane. To complete the 5D analysis, the payout ratio is currently at 16.7%. Apple's dividend is more than safe. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.3. Now let's move on to Apple's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Apple's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Apple's stock fair value at $227, which is 8.6% above the current stock price, indicating that Apple is slightly undervalued. The bull case prices Apple's stock at $273, which is 30.5% above the current stock price, suggesting the stock is still undervalued. Finally, the bear case prices Apple's stock at $182, which is 12.8% below the current stock price, indicating potential overvaluation. In summary, Apple earns a final rating of 3.3, with a weighted average price target of $227, implying a 6.3% undervaluation. Apple's status as an industry titan is confirmed by its robust growth, increasing profitability, and strong financial health. Key drivers of its success include continuous product innovation with lines like the iPhone and Mac, the expansion of high-margin services such as Apple Music and the App Store, strong brand loyalty, and strategic global market penetration, particularly in China and India. Looking forward, Apple's growth will be driven by advancements in AI and machine learning, with initiatives like Apple Intelligence and partnerships with companies like OpenAI. Efforts to enter new markets and offer more affordable products will help capture a broader customer base, while expanding services and subscription models will continue to boost growth. However, Apple faces challenges from intense competition with tech giants like Samsung and Google, regulatory and legal issues, supply chain vulnerabilities, and economic fluctuations. Based on all this, my final verdict is, next round, Analysis 2.0. I plan to dive deeper into Apple's business to better understand its future growth drivers and main risks. To make sure you don't miss that video, subscribe to my channel and stay tuned.